Good evening, everyone. A very warm welcome to all of you to this special session on Integrated Business Solutions paper organized by Board of Studies Academic. In today's session, we are going to discuss one of the most important case studies from Case Study Digest. This is not a theoretical or hypothetical story. In fact, it's a replica of real life company. And the decisions you will analyze today are exactly the kind of decisions faced by business leaders in practice. The case we will discussing today is Refresh Tea Limited, a company that began its journey as a traditional plantation business and then made a bold strategic transition to become a fully integrated branded tea company and eventually a global player. Before we deep dive into the case, it is important to appreciate a few key insights about the Indian tea industry because the context explains why the decision taken by Refresh Tea Limited were necessary and strategic. The Indian tea industry is unique. It is agriculture at the up, at the upstream level, manufacturing driven in the midstream, and brand and distribution led at the downstream level. Okay, while the tea cultivation is labor intensive and exposed to climatic risk, value creation actually happens in blending, branding, packaging, and supply chain efficiency. Therefore, to understand this case study, you must be aware of supply chain of this industry. Okay, historically, plantation only players operated on thin margins and remained very weak to price fluctuations at auctions. Further, tea consumptions in India is region specific and price sensitive consumers differ across states. Leaf versus dusty, strong versus mild brew, economy versus premium pricing, so on. Successful tea companies therefore operate multi-brand portfolio and follow segmental pricing strategies rather than a single uniform pricing approach. At the same time, the industry faces continuous cost pressure, rising labor cost, climate situation, climate uncertainties, regulatory overlaps between agriculture and business income, and increasing expectation on quality and compliances. This makes the vertical integration, supply chain control, and strategic cost management critical success factor here. Refresh Tea's strategic shift from merely functioning tea leaves to becoming a branded integrated tea company must be understood. As we go with this case, I request all of you to shift your mindset. Please do not read this as students searching for subjects wise answers. Instead, read it from the perspective of a deputy manager of finance and strategy, a finance director, or even a CEO. Someone who has to take integrated decision. You have to take decision holistically under the pressure of competition, regulation, and risk. You will notice that this case touches multi-dimension strategy, costing, supply chain management, financial reporting under India's 41, taxation, audit judgment, risk management, and corporate expansion. This is exactly how problem arise in real business. Okay, company don't face FR problems or strategic problems, they face business problem. Therefore they have to think holistically. The importance of this case lies in how refreshed tea entered a saturated market, redefined its value proposition, gained control over its supply chain, and emerged as a market leader. At the same time, India's 41, India's 2 accounting estimates, audit consideration, taxation, and agriculture income decisions you have to take care of. So, as we proceed with today's discussion, I want to keep you asking yourself one critical question. If I were sitting in the boardroom of Refresh Tea today, what decision would I take and how would I justify it technically, strategically and ethically? By the end of this session, you should be able to connect business strategy with accounting standards, with taxation, audit, and risk issues. Because that is the requirement of the integrated business solution paper. We are privileged today to welcome CA Amit Rathod sir. He is qualified chartered accountant with more than 15 years of experience across offshore and client facing issues, specializing in audit and statutory reporting for Indian as well as overseas clients. Currently, sir is director at SN Dhawan and Company Forvis Mazars in India. He has successfully established and leads the Audit Talent Hub, building a scalable, high performing audit delivery unit with strong governance, low attrition, and high engagement. He has led critical initiatives such as 50,000 audit hours and strong global audit delivery through strategic partnership and process standardization. With this, let us commence today's discussion and explore the case in detail. Sir, over to you.
Thanks a lot, Deepak ji, for introducing me and giving the background of this particular case study that we are going to take it up today. To all the students and everyone who is present here, I mean, when Deepak sir mentioned about the importance of this particular case study, I will say it is not even 1% exaggerated. The point is that this case study is really very important. And these kind of practical instances, these kind of practical situations, and how to deal with these kind of practical situations is really an acumen that anyone in the society is expecting from at least a chartered accountant or professional. So I'll be moving ahead with the case study that we have. Coming back to one thing that I want to kind of clarify in the beginning. Today, in today's session, this session will be until 9:30. So 30, half past 9 is something that we are targeting, and we are going to cover around two case studies in this particular session. So one case study is about this tea business. The other one will be there after. Once we will complete this first case study, we'll take a small break and then we will begin with the second case study. So you may feel like the speed with which we'll be discussing is a little uh, uh, I mean more than what we hereby we will, but still I will try to go as slow as possible considering the time limit that we have going through the case study itself. So I'll be just sharing my screen for the benefit of everyone, and then we'll start going through the case study. I hope my screen is visible to everyone.
Yes.
Okay. So now going ahead, this is the case a company known as Refresh Tea Limited, RTL. And as mentioned by Deepak sir, this is a practical case study. This is actually in relation to a company which is existing and is one of the leader in the tea segment when it comes to the industry. So Refresh Tea Limited was established in 1935 and it headquartered in Kolkata. The company Okay, the company owns several plantation in North. So everything that is mentioned here, it is everything is actually very relevant, because this all will be in no time you will realize that every single information which is mentioned here is very key information that will have some significant in the decision making that you are going to do for this particular company. So they own several plantations in the northeast India and in the south India. To be specific, like Kerala, Tamil Nadu, and Karnataka in the south India, and Assam and West Bengal in the northeast India. It started out as a producer of the tea leaves. Okay, so this is very important to understand that they started their business as the producers of the tea leaves. So if you understand the tea business, you have to plant the tea leaves, and then after doing that, the harvesting, etc., either you can sell those tea leaves or you can further process them to make the actual tea to sell to the domestic customers. So the company started as a producer of the tea leaves. They have their own processing centers within their plantations, estates, or the tea gardens to dry, ferment, and cut the tea leaves. So if you see these processing centers, they are not there to kind of manufacture or to build the tea for the end customers. They are there just to the plantation, the processing centers at their plantation estates. They are there to harvest, to dry, to ferment, and cut the tea leaves. The company would then auction the tea leaves to the traders. Okay, so it means they are not going and processing it further for the end consumer, but they will be then handing it over through an auction process to the traders, and these traders will be selling them to the tea companies. Now, these tea companies basically downstream supply chain, whereby the top producer will be sending it across to the other companies through a channel of the traders, and these companies will be processing this further to be sold to the ultimate customer. And when these companies, the other companies, will be purchasing tea leaves from RTL, they will be blending it, packaging it, and then they'll be reselling it to the customer after doing those marketing channels and all. It means these companies to whom the tea leaves are being sold, they are the companies who owns the brand. So they are the companies who will be buying it from the RTL, and then after doing blending, packaging, they'll be reselling it to the customers. I hope the the facts are, I mean, going pretty much clear, because this all we will be using when we will start answering the questions which are related to this case study. RTL continued to be a producer of tea leaves until the mid 1980s. So 1980s, mid of 1980s, this was the time. Till then, the RTL remain as a producer only of the tea leaves. If you see, they started their operations in somewhere 1935. So it is somewhere around close to 45 years. They were only doing the or producing the tea leaves, until which time it only auctioned the tea leaves to the traders, and then these traders used to sell it further to the tea companies. Over the decades, the popularity of the tea as a beverage increased manifold due to clever and attractive marketing campaigns. Marketed as a health drink that would provide relief for ailments like cold, flu, or body ache, tea as a beverage slowly became popular across the country. So RTL has actually seen this whole process of tea becoming so popular that it's a need at every Indian household. They have seen it, they have witnessed it throughout the process. Marketed as a health drink that could provide relief for all this. Now, tea has both an organized branded pre-packaged market as well as unorganized unbranded market, loose lot sales. So you must have noticed that this in your surrounding, that there are, like, especially the street vendors who are selling tea, etc. They are not buying the organized branded pre-packaged tea, while they are going for this loose lot sales. So the tea market is actually existing for both kind of varieties. So they are available for the organized branded pre-packaged and unorganized unbranded as well. Different versions of brewing and making tea were practiced, and this concocted to a success story of exponential proportion. Okay, so there are different ways through which these tea leaves are being brewed. So you must have seen when you go to a kind of a shop to purchase the tea, you have multiple options which are available. So there are dust teas, there are leaf teas with additional ingredients. I mean, so there are multiple ways through which this tea is being sold in the market. Increasing popularity of the beverage promoted RTL to expand the scope of its business. Okay, since RTL is already into this business, when they see that there is an increased popularity in the beverage market around the tea, then the RTL also thought that they can expand their business. For this, what they have done, it wanted to continue its plantation business. So they were not like giving up on the plantation business to enter into the manufacturing or building manufacturing this particular tea business, but they what they did actually, they wanted to continue with the plantation business simultaneously, but now it also wanted to expand its business to include the blending, packaging and marketing of the tea. So they are just extending their business rather than replacing it with the existing business. So the plantation business is already there, now they are entering into the business of blending, packaging, and marketing of the tea. RTL would increase the production of the tea leaves in its plantation using both its existing estate as well as by acquiring new tea estates to increase production capability. Now, you see, with whatever they were able to create through the plantation business, they already must have existing customers, be it those traders who are purchasing tea leaves from them and selling it to the companies further for blending and mixing. But now, since they want to enter into the second segment, which is the vertical segment, and then they want to do the blending and packaging on their own with all on their tea leaves, there is definitely they started looking for extending the capacity as well, because now they need it for their own production and probably for the existing customers if any they are there. So RTL would increase the production of tea leaves in its plantation using both its existing estates as well as by acquiring newer tea estates to increase production capability. When they were planning to acquire newer tea estates, it does not mean acquiring or buying or owning those plantation kind of plants is the only possibility. They may go for purchasing from the open market as well. We will see how they are strategizing this going forward. Now, all tea leaves will be processed further. So they'll be dried, fermented, and cut at the processing center within its plantations. So they will be doing this processing of the plant leaves in the plantation centers that they have. The management of the RTL decided that it would, from this point, also start blending, packaging, and marketing its own tea. For this, it built and gained ownership of the necessary factory resources and infra for blending, packaging, and marketing its tea. So they invested in the production capabilities, they invested in the resources so that they can enter into the second segment, a segment whereby they will be blending and packaging the tea further for the end customer. Production resources and infra were owned and controlled by RTL. This packaged tea will be sold directly to the wholesalers and retail traders, dealers who would in turn sell it to the final consumer. So they are actually in between. There were a couple of, I will say, there were a couple of chains or couple of middlemen that they are just trying to eradicate from between. So the trader who was purchasing tea leaves and selling to the company is someone who is gone out of the supply chain. Simultaneously, the company who was buying these tea leaves and then uh, they were kind of blending and packaging it for the end customer, they have also gone out of the picture. So these middlemen are not there. In fact, the RTL has decided to process it and sell it directly to the wholesalers and retailers who will be selling it to the final customers. When RTL decided to become a full-fledged tea company by the mid 1980, okay, something one point which is to be noted, that the market was saturated with many sellers. So what happened, the competition was very high because there were a lot of companies who were already existing into this particular market, and since the company was only into having this plantation of the tea leaves, etc., they never thought about that by the time they will plan to enter into the market will already be saturated with many sellers. Most of them bought tea leaves from traders at various auctions, blended, packaged, and marketed the tea. So, through this statement, the case study wants to see market sellers buying in the market, the tea. For these other suppliers, it took approximately 80 days from the time the tea leaves were was plugged to the time the consumer purchased it. So this is the 80 days of a turnaround time. So if a tea leaf is being plugged, like, because this will be going through an auction process, so the trader will be buying it and then supplying it to the company, and then the company will be further processing it. It was a time consuming process, and from the tea leaf plugged to the consumer ultimately when they purchase, it is around 80 days of a time. They catered to consumers from all strata of society, all levels of society they were selling. Now, all society level means the premium quality as well and the economy quality as well. So, premium tea dominated the branded market, while people who could not afford it were satisfied with the unbranded loose teas that could be bought as per their individual requirements. So, both kind of teas market is there, premium as well and the economy as well. RTL decided to establish itself in a branded market. So they are catering, they are focusing on the branded market. So they are not planning to go into the loose sale kind of a model. Unbranded loose tea was perceived to be of lesser quality as compared to the branded prepackaged tea, and therefore could not command much price in the market. So they are saying unbranded loose tea, it was very difficult to sell them with a premium, because generally they are considered to be cheap, of low quality, so they cannot be sold at a premium price. RTL conducted detailed market research and found that consumers from different regions had different taste preferences. So obviously, if you want to create a brand, you have to go in the market to do the market research, market study, to understand that what kind of segment of people, what is their need, what is their pain, and what is exactly they want to gain. So there is a lot of things that a market research will take, and accordingly, according to the results of that market research, the company generally decides that what area, geographical segments they need to launch what type of products. And in the same manner, what segment of the consumers, the customers, what level or what kind of products they will be launching. So when they have done the market research, they got to know that the consumers in the Bihar and the Jharkhand, they prefer tea leaves, while consumers in the Maharashtra and Gujarat, they preferred tea dust. So this is the taste of the customers. So consumers' taste is different according to the geographical locations. RTL therefore created different brands that catered to different markets. In terms of taste preference, leaf or dusty, as well as different price brands, economy or premium. So in short, they launched four varieties of products. To give you a kind of a simple example, two broader categories were leaf or dusty, and then two subcategories were there for each leaf or dusty. There was premium or economy class of a product. So they tried to capture the whole of the branded market, be it any customer who is looking forward to buy any branded products or pre-packaged products, be in the premium segments or economy segments, be in the leaves or the dusty. They launch the products in all those segments so that customers from that segment can be, the demand of those customers can be satisfied. Was kept higher than the, obviously, so the quality of the RTL's pre-packaged branded tea was kept higher than the unbranded tea sold in the loose lots, and at the same time the price of its packaged tea was kept slightly lower than the other premium varieties available in the market. So this is the pricing strategy of the company, whereby they kept the quality higher than the, when the competition tried to the so thus RTL decided to place itself in the middle of the market spectrum in terms of the quality and the cost. So it's sold premium. Both of these were they were started selling in Maharashtra and Gujarat. As part of its marketing strategy, it created a separate brand for each target customer audience so that the quality and the price could be easily recognized by the end user. It is the product differentiation strategy of the company, whereby they differentiated their products on the basis of the quality, on the basis of the ingredients, so that they can create a brand recall value. right? So when you see about a particular tea brand, segments of the teas for different customers, and every time you're talking about a particular segment in the same brand, basically in the same product. If you'll talk about a uh, particular brand, or I will say the segment's name, then you know what kind of customers they are created to cater to. So they have also given the different names to these categories so that a customer can easily recognize the ultimate reason of having that kind of a launch of product. RTL further aimed to deliver the tea to the final consumer within 20 days. If you can recall in the previous para, it was like for others it was 80 days from the time the tea leaf was plucked and to reach to the customers. But they tried, because they have this plantation, they tried this to be reached in 20 days. The new vision statement of the RTL was then reframed as, so they changed their vision statement and then they wrote it to be the most admired tea company across the globe. Okay, so earlier maybe a different vision statement was there because they were not the tea company. At that time, they were just a plantation company who was selling tea leaves to others. But once they decided to expand into that market, they changed the vision to be the most admired tea company across the globe. The new mission statement also changed for the RTL. So vision and mission. If you are changing the vision, the mission will automatically you have to change, because mission is just a kind of a process, a route map, a roadmap, I will say, to reach to the vision. So they change the mission by saying that to enhance customer experience by making tea a global beverage of choice, understand and influence taste and preferences by bringing unique quality, affordable tea to be discerning palates by the customers. Today in 23, the total Indian tea market is estimated to be 34,000 crores. This is the Indian tea market, with branded businesses constituting approximately 74%. So 26% market, total market share, is actually for the market which is selling the unpackaged or unpolished or these loose sales of the tea. So 74% is with the branded markets. The global tea market is estimated to be 45 to 50 billion. So dollars. Okay. So if you talk about this, maybe, like how much? 3.5 billion dollars in India, but overall it is around 50 billion dollars at a global level, with the main demand coming from the black tea segment. RTL has emerged as the market leader, commanding 60%. So with their strategy, in the domestic Indian market, they were able to capture 60% of the market. It is a listed company now at the BSE and NSE. Demand in other segments like green tea, fruit and herbal, decaf, and especially tea, among others, is also picking up. So it is not only the traditional tea which is there in the market, but there is a competition. Okay. So it is not like, if you're thinking that you are in a tea business, then only the tea companies or the competitors who are working in this particular segment, they are the competitors. You see, you have to expand the horizon, and you need to think that what are my and who are my competitors. Identifying the right competitors is also very important. I'll give you an example. Like when Pepsi and Coca-Cola were their only two brands, initially, when people were not that much interested in buying Pepsi and Coca-Cola, Pepsi realized that Coca-Cola is not the only competition they are facing. And then they finally concluded that even the water, even the juices, even the tea, coffees, they are all are in competition with them. So if somebody wants to drink something and suddenly they will be able to locate a water bottle and then they are drinking a water bottle, it is also killing the sales of PepsiCo, right? This is how they actually identified the competitor and then finally came out with different ways to make the product available. Whenever a customer is thirsty, wants to drink something, they try to place their product at that level. So instead of buying a water or a juice, the customer can end up buying PepsiCo's products. This is how. So in the same manner, when they launched the tea, they realized that it's not the traditional tea which everyone was doing, like the black tea segment is not the only competition, but now they are facing multiple other competitions as well. Like the herbal tea is there, green tea is there, fruits and herbal juices, etc. is there, is also picking up because people are getting more health conscious. Taking note of this new trend, RTL conducted market research and a survey done of the entire beverage industry. So you see, it is not the tea industry, but it is the entire beverage industry to understand the consumer behavior shift to gather market intelligence and emerging customer choices. The findings reveal that consumers are becoming more health conscious. This is exactly what we were discussing. It is not only the black tea. Now, even the herbal, green tea, etc., they are also in competition with the company. Their choices. In the past 2 years, demand for fruit juices, coconut water, almond milk, milkshakes has increased. According to the study, the shift towards healthier beverages choices like fruit juices, coconut water, almond milk, and milkshakes is projected to grow and encompass at least 8% of the beverage market within the next 3 years. So you see, this other new emerging market. So it is not only the competition, the existing competition that we should be worried about, but we need to be little visionary. We need to think about the future as well, and then we need to see that what is there in the future, which is going to launch or the customer's interest is getting shifted to. So we should be thinking that aloud. So the company has started thinking, and then they know that in the next 3 years, the beverage, the other products market will also grow to the 8%. And if this market is growing, why we should be worried about it? Because this market will ultimately consume the product that I am in. So it is an indirect competition to me. And this is really very important. When we started doing this market research for one of the company, we realized, this was such a funny kind of a study which came across. And then people started thinking about this UPI. When UPI got launched, you will not believe, but UPI was not only a threat or a competition to the existing banking channels or models. Later on, people realized that this is one of the very big competition to the toffee industry as well, which was not at all linked, or people were not able to think about it. You see, in most of the cases, the toffee industry in India, their sale was totally dependent upon the change, right? The lose money. So whenever the customer, the shopkeeper was not able to figure out or doesn't have this change, they used to give the toffees as the change to the consumers. But when UPI came up, this trend went out because nobody needs a change anymore. So nobody is interested in taking the toffees as a replacement of the change or the coins. So the demand of the toffees started declining. You know why? Because UPI got launched. Just think through that how and what kind of irrelevant markets they are operating into, but still they are competing with each other. So in the same manner, this is not only the tea competition. This is now a beverage competition that is going on. Now coming back to, there is another company which is simultaneously in UK. Okay. Now let's see what this company is doing. So Tea King PLC. TKP is a UK based company that produces tea bags. Okay. There is another company in UK. They are producing tea bags. Okay. Small sachets of tea bags are dipped into hot water in order to brew conveniently within a cup. The sachets can be conveniently disposed of after the use. Tea bags are hugely popular across the globe, primarily due to the convenience of use and disposable. You see, anywhere, anytime. This is a very big statement, and because of this, they were pretty much popular. So, unlikely the traditional tea, whereby the black tea that you need to brew and then you need to use it, consume it, they were readily available. You can use them anywhere, anytime, and then you can throw them. So, they were pretty popular. Is a highly recognized tagline for TKP's tea bags. The company has a net worth almost 3 times that of the RTL. So this company is that big, which is almost 3 times of the RTL. TKP has a deep market presence in the UK and the USA, as well as a few other European countries where tea is relished as a beverage. Despite its huge global presence and scale, the ownership of the TKP has changed hands frequently every few years. Now, the problem is the leadership. The ownership of the TKP is not stagnant. So, the stability is not there. They are frequently changing. And this is because the profitability of the business is constantly under pressure due to the high input cost of the tea, driven by inflationary conditions. Now, you see, just because you are you're big in volume does not mean you are big in profits as well. The profitability totally depends upon your whole supply chain. It's not only the product or the kind of placement of the product that you have done in the market. So even though they were able to make a kind of a three times of in size of the net worth, but they were struggling with the profitability for this particular project, and that's why the leadership was frequently changing. TKP imports tea leaves, its raw material, from various countries, and the cost of imports has become more expensive over the years. Now, see why the profitability was a kind of a problem for the company, because they were into the import of tea leaves. So they don't have any plantation farms and all. And here, our company, which is RTL, has a different kind of a ground to play because they have the plantations as well with them. So while the TKP was importing goods and the import cost is increasing over the years, the RTL may have this as an advantage because of already owning the plants. Now, RTL has recently gained the opportunity to own a controlling stake in the TKP. So they were able to gain the controlling stake in the TKP. This is a prestigious development for RTL as it has been trying to increase its global footprint, particularly in the UK and USA. Okay. So RTL is also now they are already sitting at around 60% of the domestic market share. So they are also planning to expand their operations to globally. And in this expansion, they thought gaining a controlling stake in TKP can play a very big role. So it can definitely open doors for them. So now the advantage the company has that most of the previous owners of the TKP did not have, that RTL has better control over the supply. Now you see, this is what we were discussing, isn't it? That the other companies, the other leaders, they were facing a problem that their supply chain management, supply of raw materials especially, was not something which was under their control. But since RTL is already sitting there, RTL is already owning that kind of a business, and then they have sufficient more than 45 years of experience when even they started. Now they are already they have more years of experience into the industry, so they know how to control the supply of the raw material. India is one of the major tea producing countries. RTL has been in the plantation business since its inception. Hence, RTL is much better positioned to scale up the tea leaf productions to meet TKP's raw material requirements in a cost effective way, thereby countering any inflationary pressure. Okay, so even if the inflations will be there, since the RTL is sitting and having plantation business of its own, it is not going to create an additional pressure on the company. Company knows how to handle it. They are working with this kind of a segment since their inception, have sufficient experience in the industry. So they definitely think if TKP is not able to produce the result that they could have produced, and the main reason is because they were not able to control the supply chain related to the raw material, the RTL is thinking that this can be a very big game because the weakness of the other company is the strength for them. So if they will have a controlling ownership on the other company, this can become a very big game, and then it can open up their plan, the expansion plans. It can also help them with those expansion plans in UK and USA because TKP has already a very well established market over there. However, since the size of the deal is much bigger, you see, three times of RTL, this was the size of the company. RTL's net worth, it has to resort to taking significant amount of debt. Okay, so that has to be there to finance the deal. The deal has the approval of the majority of the shareholders, and other regulatory approvals are already in place. So from a approval perspective, they have no issues. It's just like whether this decision is going to make any economical sense or not is something that they need to think about, which they concluded earlier, right? So, in the dynamic field of the tea production, external factors such as unpredictable weather conditions can severely affect operations. Recognizing the importance of proactive risk management, RTL has implemented a comprehensive strategy to mitigate potential disruptions and protect its plantation, specifically in the northeastern region. This includes ensuring adequate insurance coverage, positioning RTL to effectively navigate the uncertainties associated with cyclones and adverse weather events. Okay, so they know because they are already in the market, so they know that what kind of problems can be there, and for all those problems, they have some strategical kind of alignment already in place. So they have taken necessary insurances. They know how to deal with what kind of a situation. RTL's financial statements are prepared in accordance with the Indian accounting standards and under the Companies Act 2013. Okay, so this is the study. Now we will move to the multiple choice questions. I have tried my level best to go as slow as it was possible and to explain the whole of the case study so that when we will start reading about the questions and then we'll start identifying the answers or drafting those answers, we will at least have an understanding of the whole case study. So we are moving to the multiple choice questions now. The first question is basically which of the following statement is true regarding the current expansion plan of the RTL, acquisition of TKP, and the expansion of RTL in the mid 1980s? So they are saying that there were two expansions that actually happened. The first expansion was whereby RTL decided that they will be entering into the uh, processing of the tea leaves, okay, blending, packaging, and then reselling. So they this was the first expansion whereby they will not be only a plantation company, but they will be entering into the main market of the black tea, right? The second thing is second expansion was whereby they thought they will be expanding now into other geographical regions in UK and USA, and for doing that they acquired a controlling ownership interest in the TKPs. So there are a couple of statements we need to read, and then we need to identify which one is the correct one. The first one is the current expansion plan of the RTL, acquisition of the TKP is horizontal integration, while expansion in the mid 1980 is a vertical integration. Okay, we need to understand the types of integration. So they can be horizontal, they can be vertical, they can be backward integration, then they can be forward integration as well. So in the case of RTL, we are seeing two types of expansion were there. One is the horizontal and the other one is the vertical. We need to decide, we need to kind of finalize that which one vertical, which one expansion was what kind of vertical. So now you see for this expansion plan, when a company is trying to enter into another segment, right, which is vertically associated with that company in any manner, then that is known as vertical integration. But if the company is going and expanding with the horizon or increasing, not in the vertical segments, not in the segment which the company's products are related to, but to the geographies or to the competitions, they are trying to kill the competition around, then it is a horizontal kind of a competition. Okay. So when the base is getting increased, it is horizontal. But when they are increasing the verticals, the segments of business, then it is a vertical. So when you talk about entering into another business, which is the second leg, the second stage, I will say. So when you move to the second stage, another piece of the ladder, I will say, it is a vertical integration. But when you are talking about TKP, you are in the same business. So it is not like you are going after into another vertical, right? You are just expanding your existing capabilities and moving to different geographies. So that will be a horizontal. So what we need to do is to find out that the current expansion plan of the RTL is a horizontal integration, while the expansion in the mid 1980s is a vertical integration. I think this first seems more logical because in the second they are saying the current expansion is vertical, which doesn't seem correct, and while the expansion in the mid in 1980 is a horizontal. I hope the question is very much clear to all of you. And the current expansion plan and the expansion in the mid both were vertical or both were horizontal. So the correct answer should be the current expansion plan is a horizontal integration, while the expansion in the 1980 was a vertical integration. Okay, we'll be moving to the second multi-choice question. Now, the regulatory authorities in India have to assess whether there is any breach of the anti-competition law. Which type of stakeholder will the regulatory authority be classified as using Mandlow's matrix? Okay. Now, there is a Mandlow's matrix which shows that there are two types of people, right? So, I mean, the stakeholders which the company has to face, has to kind of report to can be of two types, right? So they may have two types of interest in the company, if I'll say. So one is how much influential they are, what level of power they can use, and then what level of interest they have in the company. So depending upon how much powerful they are in terms of impacting the company's decision, and depending upon how much interested they are in the company's business, it shows, this Mendel's metric shows that how to respond to that kind of a stakeholder. You need to keep them informed only, or you need to give them a kind of a significant amount of details before you take, or you need to take their approvals. That way the Mendeley, the matrix explains everything. Okay, so I'll quickly show you as well, because this may be a kind of a new thing for you guys. So if you see about the Mendeley's matrix, this is how it is. So the stakeholders which are there, they can either be very much interested, or they may have a power to impact the decisions of the company. So if they have low interest, okay, but they have high power to kind of impact the company's business, you need to keep them satisfied. Okay, because they have power to impact. So but interest in the business is low. It is like the government, right, like the regulatory authorities, etc. So they are very powerful in terms of uh, impacting the company's decision, but they are not that much interested in the business. So for these kind of cases, you need to keep them satisfied. For somebody who has minimal, I mean, kind of an effort, because they have minimum power to impact, or they have minimum interest in the company, maybe like shareholders, etc. You can say we need just minimum efforts, right? Whatever the minimum requirement is there, you need to fulfill them. If there is somebody who has low kind of a power, but they are highly interested in your business, okay, maybe I'll give you an example, maybe a media house. Okay, so they may have very much interest, because the kind of company or the industry that you are operating, they have kind of very keenly interested into it, but they may have low power to impact your decisions in any manner, so you need to keep them informed. But if there is someone who has high power to impact, and then probably highly interested in your business, so they are the key players of the business. They can be the board of directors, they can be the CEOs, CFOs, and all. These are the stakeholders. So what level of a person is something the company has to decide how they are going to respond to them. Okay, so for, if we are going back to the case study that we were going through, then it says that we have a regulatory authority in India which checks about the anti-competition laws and all. Since it is a regulatory authority, and we just discussed that the regulatory authorities may have high power. Okay, they are very powerful in terms of impacting the decisions of the company, but they might not be that much interested. So they have, like, government authorities, regulatory authorities, they may have low interest, but they have high power. So we need to think about from that perspective only, and then answer accordingly. So if you see the regulatory authority, the first option is a marginal player with low interest and low power. So with a low interest and low power, we don't think this is the correct answer. The regulatory authority is a key player with high interest and high power. The regulatory authority is an influencer with low interest and high power. The regulatory authority is an affected player with high interest and low power. Now, after understanding this Mendeley's matrix, I know everyone is aware now that this particular answer, whereby the company, the regulatory authority with the low interest but having the high power, is the correct answer. Okay. So we will, for this second, we will go with the C. I hope it's not only, like, putting a tick in the box, but you are also able to understand that whatever is kind of a solution is there, or how we are coming to the conclusion as well. Now the third multi uh, option question is that TKP has used the tagline. So if you can recall, TKP, which was pretty much popular in UK and USA, they were using this tagline, anywhere, anytime, to the market. It's T bags with reference to the value proposition map. Now we need to understand the value proposition map as well. Okay. In the value proposition map, if you are aware, then we need to identify that what is the pain of the customer is. and how you as a company, what kind of products or services you can launch which is relieving the customer from that pain, right? Simultaneously, you need to also see that what is the gain the customer is looking forward to, and then what is the gain creator that you have. Okay, so let us suppose if somebody is actually looking forward to gain muscles, just to give you an example, right? Then maybe the gainer is the muscle, but your product has the high protein, right, into that particular product. It is the gain creator for the customer. So if a customer is looking forward to have that kind of a gain, then your product should be satisfying that gain, right? So the product should be a gain creator. In the same manner, let us suppose somebody is trying to get relief from smoking as a habit. So smoking may be a pain for them. So if you are trying to cater to this kind of a requirement, your product should be placed in the market in such a manner that it can create pain reliever. So it means the pain the customer is going through the having the smoking as a bad habit, your product should be able to relieve the customer from that pain. It means you need to advertise your product, you need to market your product in such a manner that the customer may believe, that customer can believe that your product can relieve pain for them. So now there are four particulars, and in the same manner they have four elements of value proposition map. So the company is asking you to match them. So when we are talking about the brewing tea, what is a brewing tea? A brewing tea is basically the black tea that we were talking. And you see, if you can recall, TKP was selling this because it was anywhere, anytime. So the brewing tea was actually a pain for the customers, right? Because they are not able to. Uh, it was not a ready-made, or it was not anywhere, anytime. That was the pain that the customer was going through, and take TKP's product, which started coming in those sachets, tea sachets, right? It actually helped the customer from relieving that pain. So if you'll talk about brewing tea, we will say it was a pain. So the first is going with the fourth. And what was the solution around this brewing tea? So if there was a pain, okay, then the pain was getting relieved by tea bags. Okay, so tea bags became a pain reliever for the customer. While brewing tea was the pain, the tea bag became the pain reliever. In the same manner, when customers started focusing on health, customer wants to gain something. It's not the pain anymore. Customer wants to gain health. So when you talk about the B, this will be the customer is looking for a gain, and how customer is looking for a gain and what can help you creating that gain is the green tea. So when somebody is launching green tea, they are saying that the health can be better. It has antioxidant and all xyz things that people are talking about. They are saying whatever you want to gain out of a product, we are able to provide you that gain creator. So this is known as the value proposition map, whereby you are mapping your product's specifications or values to the requirements of the customer. So you see what is the pain of a customer, what is the customer wants to gain out of this product, how your product can relieve a customer from that pain, or how your product can create that gain which customer is looking forward to. So this is a very simple question, and if you see, the answer will automatically be A is mapped with fourth, B is mapped with the first one, C is mapped with the second one, and the D is mapped with the third one. I hope this is also clear. I'm just going a little in detail. I just don't want to do a tick and tie, like making an answer that simple. I want you to give an idea also that what is going on around it. Okay. Now the fourth question is basically the blending machine at the Nagaon, Assam. Now we are talking about the machines and all. Factory blends tea leaves varieties produced in the plantation of RTL. Okay, be careful. Factory blends tea leaves varieties produced in the plantation. Due to the increased seasonal demand during the monsoon, the production of the tea increases in the factory for the months of the production of the tea increases in this factory for the months of May, June, and July. So these are the critical time period. Due to this, the availability of time on the blending machine is limited during these months. Okay, so I'll say that the company's machines are working at a full capacity. There is no immediate plan to increase the blending machine's capacity since this is a seasonal variation in demand. So company is not increasing its capacity because it's just like 3 months in a year. So they don't want to invest for 12 months while those machines will be used only for 3 months. Since this is a seasonal variation in demand, and hence the constraint is short term in nature. At the same time, the production manager at the Nagaon factory wants to determine the order and the quantity of the tea blend to produce in order to maximize profit. So they have three types of blend, which is the three kind of categories, like different sub brands, I will say, that the company has launched in the market. So the production manager, because they have limited capabilities, so they can only process one blend. Or I mean, they can process a mix of all blends, but they want to produce the blend in such a manner that the profits can be maximized. So they will definitely like be interested in producing more of a brand blend, which will give them more profit. This is a very kind of like economical or commercially viable kind of a decision. So they will definitely need your help. So the selling price and the cost per kg as well as bottleneck production details are as below. Okay, so they have mentioned like for blend one, blend two, blend three, what is the contribution, how the things will go, and then they are asking. So selling price is this, material, time required. So how much time for one batch to be processed is there? So 20 minutes. It means if you will have a blend one on a machine, it will take 20 minutes. The factory cost is 5 rupees per minute. Okay. So factory's cost is 5 rupees per minute. The manager wants to rank the blend based on the throughput accounting ratio. It means they want to calculate that per minute how much the contribution is generated with each blend. And then they want you to rank the blend mixture in that ratio only, helping them identifying that what is to be prioritized. Is this ranking the company wants to prioritize, maximize the profit? Rank one means the whole blend one. If let us suppose blend one is the rank one, then whatever the blend one's production is supposed to happen, they will prioritize this only. So if blend 2 and blend 3 they are waiting there, the company will not process it until or unless there will be some idle capacity that will remain with the company's production capacity. Okay, that is the benefit of having a rank. So they're asking you to kind of calculate the accounting ratio and then provide the rank. Now you can clearly see that what is happening, like selling price is 500. So if you see for these two initial twos, it is 200 rupees of contribution, right? Which is there. And for the third one, it is 800 minus 500 is 300 rupees of contribution. But if you look only at the contribution, the problem is you will miss the bigger thing because you are kind of generating 200 rupees with blend one and in 20 minutes only. While for the same, you have to kind of in 40 minutes, you have to take 40 minutes to create a contribution of 300 rupees. So if you will do a blend one mixture and you will run it two times, you will process it twice, which will take exact amount of time which blend three is taking, you will realize the contribution will become 400 instead of blend three, which is generating only 300 rupees. I hope this is very much clear. It's a very simple kind of a equation, but it's not only like 200, 200 or 300. You also need to see that per minute contribution. How much is the per minute contribution? Okay. And then you need to see also, since the factory cost is 5 rupees per minute, you need to see that per minute of factory cost. Okay. Per rupee per minute of a factory cost, how much contribution is getting generated. And that is what a throughput accounting ratio. Okay. So I'll quickly show you so that you guys will not miss on this thing. I hope my screen is visible. Okay. If you can see my screen, the second window is also visible, and I hope it is readable. Can anyone confirm if you can read this? Anyone? So that I can move ahead.
Yes, sir.
Okay, both the screens are visible, right? And
Yes, sir.
Yeah, you can read them clearly. Perfect. So if you'll read the question again, how to calculate the throughput accounting ratio. Okay, this is a very simple calculation. So if you see for blend 1, blend 2, and blend 3, if you'll less the material and the other variable cost, this is what we were discussing about throughput contribution, which is through 200, 200, and 300. But the problem was that it was taking 20 minutes, it is taking 30 minutes, it is taking 40 minutes. So contribution per minute is 10. For the second one, it is 6.66. So you just divided 200 divided by 30 and then 300 divided by 40, which is 7.5. So per minute contribution is this much. Now factory's cost is 5 rupees per minute. So if you'll see that the accounting ratio, which is the formula for the ratio is contribution per minute divided by factory cost per minute. So this shows that for each rupees of cost every minute, how much contribution is generated by each blend. This is that simple. So for each rupee of per minute cost, the blend one is able to generate 2 rupees of contribution. Blend 2 is able to generate 1.33 and blend 3 is able to generate 1.5. So if as a production manager, if I have to prioritize with a kind of an aim, with a purpose in my mind that I have to maximize the profit, then I will try to process the blend one first. Whatever the quantity that is requiring processing, I will take that up first. So it will become rank one. The blend three, because it is giving after two. So let us suppose the blend one is finished after processing whatever the requirement was there. I will now move not to blend two, but to blend three because it is giving me better contribution. So this will become the rank two. And then the blend two will become rank three because it has the lowest margin. I will still process this because at least this is not into losses. It is actually giving me some level of benefit only. If the blend three, blend two, let us suppose if it ended up with having less than one as the TA ratio, then there is a high probability the company might have discontinued this product itself or this segment because blend two then will not be making sense. Okay, because it is giving me less contribution and a high cost. Now the coming back to the next question, which is RTL has, I hope this is also clear. Now, RTL has divisions like plantation, processing, blending, packaging, etc. The popularity of the tea has increased the demand for tea leaves in the market. Many tea companies do not own any plantation of their own. This is what we discussed initially as well, that the companies are buying it through the traders. So they are obviously dependent upon the companies who have plantation. They purchase the tea leaves directly from the tea auctions. RTL uses only the tea leaf produced within its own plantations in order to have control over the quality and price of different tea blends. So this is another very big benefit that they have their own plantation. The tea leaves, once plugged, are transferred to the processing units within the plantation. Now you see, company had a business which may be a service line or a segment or a product line, whatever you call it. So plantation was already going on. Now the company has entered into a processing kind of a segment as well. So the company would definitely like to know that how much profit they are generating through the plantation and how much profit they are generating through the processing, because they need to be sure whether this second line, the vertical expansion that they did, whether it is also making any sense or not. So if it is actually consuming the profit which is generated by the plantation business, then the decision of expanding it vertically was not a good decision. So for this, what they do, they have a transfer pricing model. It is not like the loss transfer pricing, it is the company have a price for transferring products internally, which will be nullified, which will be eliminated when you will be doing probably a reporting at a company level. It is just an internal kind of a practice. So if you see the tea leaves, once plugged, are transferred its processing unit within the plantation. The company has a transfer pricing policy for any internal transfer within the divisions. Plantations are producing at their full capacity. Brokers from the external market are offering the plantation division a price of rupees 200 per kg of plugged tea leaves. This is very important. Now, my plantation. kind of a segment, vertical. They can directly sell all the leaves through an auction process to the traders, and the price they will be able to fetch is 200 rupees per kg. So they will be easily able to sell it in the market because there are a lot of people who wants to purchase leaves. While the marginal cost of production has been determined at rupees 170 per kg. The marginal cost of production has been determined at 170 rupees per kg. The net marginal price, selling price in the marginal cost at the processing division is 200 rupees per kg. The net marginal price. While the price at which the processing center can purchase tea leaves, procurement price of the similar quality from other plantation suppliers is 205 rupees. Now you see, if the company does, so there are two different service lines we are talking here. The one is basically a plantation and the other one is the processing. So the company says that we have 200 rupees per kg, a market price readily available for my plantation business. If this plantation business is selling its products or sending its products, its leaves, tea leaves to the processing unit, right? They would definitely like to generate some profit. So that wherefore internal reportings, for MI's reportings, for knowing the performance of that particular segment, they can go back and tell the leadership that this is what is happening in this particular segment. So they know that they can fetch easily 200 rupees from the market. So they will definitely see that 200, minimum 200 is something that should be transferring. The internal transfer price should be 200 rupees. They will not be selling below that. Because if the processing unit is buying, let us suppose anything below 200 rupees, even if the marginal cost can be 170 rupees, right? Still, the particular segment, plantation segment, may incur losses in the books, obviously not in reality, which they would definitely like to avoid. Okay. In the same manner, if the processing unit, they don't want to buy products, let us suppose, from the plantation unit. They are saying the plantation unit is giving us a price which is higher than the price available in the market. Okay. So they will go in the market and purchase it from there rather than buying it from the plantation team. So if they are going outside and trying to buy the product, then they are getting a 200 rupees of a price. Okay. 205 rupees of a price. So my plantation company can sell it, unit can sell it 200 rupees in the open market. But when my processing team is buying it, they are able to buy at 205 rupees. I hope this is clear. Note, selling price for the processing division is actually the transfer price it charges to the blending division for each kg. Okay, so this is just a note. Now, the managers of each unit have their performance assessed based on the surpluses each division generates. Okay, so this is what we told, like the plantation division, whatever profits they will be generating, on the basis of that profit, their performance will be assessed. Which of the following transfer pricing range will bring goal congruence between the plantation divisions and the processing divisions? So now you see, so we have two divisions, plantation and processing, and we don't want them to fight with each other. We don't want to go them to go in the open market, right? So they if they will go in the open market, there will be a problem. The processing division will buy a product at 205 rupees, which is sold by my plantation division in 200 rupees, incurring a 5 rupees of loss per kg. So I will set up transfer price, which will be between these two prices only. So I will see that the minimum of 200 rupees per kg, because the plantation division will not sell below this. Okay. Because if the processing division will ask below this, the plantation division will sell it outside in the market. In the same manner, the maximum, the price which should be there as a transfer price is 205 rupees. Because of my plantation division will like to sell this at a higher price than 205, then what will happen? The processing division will start buying it from the outside. So there can only be this, either 200 or 205. What will be the exact price, to be honest, will depend on the negotiation skills of my managers, the plantation division and the processing division's managers. Okay, because ultimately the profit at a company's level will remain same irrespective of the price that they are going to fetch. It is just their manager's performance that is going to be evaluated. But if in this case, somehow it is kind of, like, if you have to decide a price, you can decide a price of 200 rupees, because ultimately and 200 rupees, the plantation company, the plantation division will be able to make sufficient profit, which they are making from the market. And this 5 rupees of an additional profit, you can pass on to the processing division. Okay. So this is how, but depends on the manager's negotiation. Moving to the next question. In August 23, RTO's tea estate in Jalanagar, Karimganj district received 10 lakh rupees as compensation from an insurance company for severe damage to the green leaves caused by a hailstorm. Okay. So now this is very important that the green leaves of the company, they were damaged because of a hailstorm, and the insurance company paid them 10 lakh rupees as a compensation. A trainee accountant in the tax at the head office believes that the entire receipt under the insurance policy pertaining to damage caused by the hailstorm to the tea leaves will be accessible as income from other sources. Evaluate this view. So the trainee has an opinion that this 10 lakh rupees which they have received from the insurance company should be treated as other sources income. Now, there you have four options. The first option is the accountant's view is correct. The entire compensation is assessed as income from other sources. Insurance commission, insurance compensation that I have received from the company, they are saying this will become a other sources income. Okay. The second is the accountant's view is incorrect. No part of the compensation consists of manufacturing income, and it cannot be proportioned and apportioned under Rule 8 between manufacturing income and the agriculture income. Therefore, income will be agriculture income. Okay. There is a Rule 8 which helps you, especially in kind of a comprehensive kind of an arrangement whereby the company has agriculture products and then they are processing it again for before they are finally selling it to the customers. Now, what will be the agriculture income and what will be the final product? So if I am growing teas and then let us suppose I am doing some blending, some mixing, some final packaging and everything, and I'm selling it a product at 100 rupees. Now I will go back to the government and I'll be like, hey, 100 rupees is my agriculture income. So I'm not going to pay any taxes. The government will definitely be like, listen, it is not going to work like this. If you will be claiming 100 as an agriculture income, the processing of that those tea leaves is not the agriculture income. Then they will start fighting that 100% is the business income. So you have to pay the taxes. It's not the agriculture income. To avoid these kind of situations, the law has like rule number 8 is there in the income tax, which says that in these kind of composite arrangements where company is dealing in an agriculture product and then processing it before reaching to the final customers, they have come up with a ratio. Like in those scenarios, 60% of the total amount can be considered as an agriculture income and 40% can be considered as a business income. This is how. So this is what is a rule 8 basically. So the accountant was of an opinion that everything should be considered as the other sources income. While if you see, they were just tea leaves. So there was no further processing that happened. It was not the final tea which was supposed to be sold to the customer. So we need to be very careful while going through these kind of options. The C option is the accountant's view is incorrect. Only a portion of the compensation is accessible as business income. Yeah, compensations accessible as business income only if they were not tea leaves, right? Otherwise, there is no logic. The accountant's view is incorrect. The entire income would be treated as business income. So why will I consider 10 lakh rupees as business income when I lost my tea leaves, not the black tea that I was supposed to sell in the market? So if the tea leaves compensation is there, it will be a pure agriculture income, right? So for this scenario, the answer that is the correct answer will be my B. Therefore, income will be my agriculture income. I hope this is also clear to you guys. Okay. I mean, it's not that difficult. The IBS, the exam of IBS is as actually, it's kind of a, I will say more or less like giving you a practical exposure, practical experience. So it is more or less like you have to get connected to various aspects. Sometimes you will be asked in a one single case study, you will have to aware about the company's law provisions. Suddenly you will realize that there is a question from the income tax. Suddenly there is something which is popping up from GST. Suddenly something related to Ind AS, etc. So you have to be little careful. And that's why this is really very important, because in the practical scenarios of your professional life, professional journey, this is what you need to do on every day, right? Because you have to think really louder than what as an expert of a particular segment can be thinking. And I'm really happy that the ICI has come up with this open book exam as well. I mean, the reason is because in the general scenarios, in the practical scenarios, you will be when a client will be sitting in front of you, you will be actually in a open book examination. So client will be happy to give you enough time to go back and search the relevant concepts, the search the relevant acts, laws, practices, industrial practices, and everything. And the customer or the client only wants you to give you them the best kind of a response. So I mean, this is very much practical. This IBS exam is really very important. Okay, I'm really sorry, I got a call in between. I'm just going back to. I hope my screen is still visible. Okay. Now the descriptive questions are there. The induction program for new hires is underway. They are being introduced to the history of the tea in India, as well as how RTL grew to be a leading player in the market. One of the new inductees ask. So the induction is going on, and there are a couple of people who are being hired by the company. They are just more curious about the history of the company and how the company has kind of expanded their businesses from just a plantation kind of a business to becoming a leader in the industry. So the question was, what is the rationale behind RTL's decision in the mid 1980s to expand its operations into a saturated market? So if you can recall, by the time they finally decided that 1980 is something that they'll be going ahead, they realized the market was saturated. It could have maintained the status quo as a plantation company producing tea leaves. So he is of an opinion, new hires, little excitement is there. So they are saying the company could have been into the business of plantation only rather than thinking of expanding vertically into the tea business, especially when the market was saturated. There were a lot of competition, there were a lot of sellers which were already there in the market. Why did it have to get into the blending, packaging, and marketing business as well? Also, how did RTL manage to become a market leader despite the competition? This is really important. So it is kind of a case study. So you have to kind of, after going through the whole scenario, you have to come up with your answers. Now the examiner, now the person, they just answer in such a manner that an industrial trainee is there who is more curious about the history. So if in case you have to come up with these kind of an answers, how will you draft those answers becomes really very important. Okay. So I'll quickly make you go through the solution which is provided to give you an idea on how to write when these kind of questions, descriptive questions are there. Okay. So you have to, after going through the scenario, you have to practically think through that what were the reasons. Okay. Like already having a great hold on the supply, raw material supply chain, etc. Already having kind of an control on the plantation business, already having that level of experience. There are multiple ways, multiple thought process. After doing the market study, they think that the market, the tea leaves or the tea dust and the economy and the premium class. I mean, there are multiple ways through which the case study itself is giving you an answer that why the company thought and how the company succeeded. So when you are giving an answer, this is what exactly you can focus upon you and you can write down. Okay. Do you want me to read this answer? Because I think this is available on your website as well. So if in case you want to go through in detail, but yes, this is more or less like related to what we discussed in the case study. Okay. So I think let's discuss more or less about the laws or the concepts related to the laws and acts so that you can get better ideas. But when it comes to the to drafting this kind of an answer, which is already given in the case study, you can go through that particular answer. Now the eighth question is about at RTL's Darjeeling plantation site. Manufacturing process commences with the plucking of the tea leaves from the plantation. Once the tea leaves are harvested, they are transported to the internal processing centers to continue the manufacturing process. This is what we have already discussed above, whereby two separate divisions were there, plantation and processing. And then there was a concept of transfer pricing as well. So this is just an information which is a repeat. The local accountant at the site is currently preparing site's financial in accordance with the IND AS under your supervision. Okay, perfect. So now the financials are being prepared. Now this accountant who is preparing the financials, they are asking whether these plugged tea leaves are agriculture produce as per IND AS 41 or not. Whether they are agriculture produce or not. The answer is yes. You have to back up, right, the in AS 41's concepts, and then you need to draft an answer. I'll quickly show you. But the answer we have already kind of discussed it earlier as well. Now, when you talk about the in AS 41 agriculture states, it says is applied to the agriculture produced, which is the harvested produced of the entity's biological assets at the time of harvest. Therefore, thereafter, in AS2 inventories or another applicable standard is applied. Okay. So by the time you are harvesting them, they are just in agriculture products, agriculture income and all. But when you are keeping them, you are storing them, you are having them for further processing and all, now this will become the inventories. Accordingly, IND AS 41 does not deal with the processing of agriculture produced after harvest. Okay. So when you're processing those tea leaves to make black tea to be sold in the open market, then the IND AS 41 is not applicable. And this is what we exactly discussed when we discussed about the insurance compensation thing as well, right? Whereby we explained that insurance compensation, because it came pour against the tea leaves, so it just cannot be a business income. It was an agriculture income. So this is the same thing which is written here. Not deal with the processing of agriculture produce after harvest. For example, the processing of grapes into wine by a vintner who has grown the grapes. Okay. So plucking of the grapes to create a wine or something, those grapes till the time they are there, it may still be an agriculture produce. So if something will happen to those grapes and you will get a compensation, it can still be an agriculture income. But once you have made them ready for processing and thereafter anything is happening, that's not an agriculture kind of a produce, then this will become the business related produce. Okay. Now, which we discussed about 60 and 40%, the government finally decided under the Rule 8, which is already there. The processing of grapes into wine by a vintner who has grown the grapes. While such processing may be a logical and natural extension of the agriculture activity, and the events taking place may bear some similarities to the biological transformation, such processing is not included within the definition of agriculture activity in IND AS 41. In the given case, RTL produces tea by processing tea leaves after they are plucked from the tea plants, that is, after they are harvested. Accordingly, any processing of harvested agriculture produce, processing of tea leaves into tea will not be within the scope of IS 41. Now, as per the aforementioned para 3, para 5 says agriculture defines agriculture produce as per the standard as the harvested product of the entity's biological assets. A biological asset is living animal or plant. Based on the above definition, at the point of the harvest, the plucked leaves are the harvested product of the tea plants, which are the biological assets of RTL. Hence, such plucked tea leaves are agriculture produced. Okay. So you answered the first question, which was whether these plucked tea leaves are agriculture produced as per the IND AS 41. The answer is yes. Second, how should such plucked tea leaves be initially measured? Now, this is very important. How the fair value will be determined. Now, the fair value is, if you can recall, like in AS2 as well, which is basically a, so you decide it at a fair value or basically a cost or NRV, if you can recall. I mean, what is NRV? It's like just the product if you are selling it in the same condition which it is available to you. So it is not like you are doing or adding up or topping it up with any sales, etc., marketing expenses or sales expenses. If those products are as it is being sold from the place where they are there, okay, where the inventory is stored. So let us suppose if you're talking about the tea example, black tea, right? So if you're talking about the black tea which is available at you at the particular year end, you want to calculate its cost. Then the cost at which the MRP, the price at which it is saleable in the open market, what you will do, you will reduce any additional cost that will be incurred to make this product readily sellable in the market. Okay, so all those packaging cost and everything, sales expenses, marketing, everything will go out of the picture, and then whatever is left, it is your fair value or NRV, you can say. Now, this NRV can be higher or can be lower than the cost. And that's what the IND AS2 as well says, that what you need to do is actually you have to value it at a lower of cost or NRV. So if you'll go through the answer, it says agriculture produce harvested from an entity's biological assets shall be measured at its fair value, less cost to sell at the point of harvest. Okay. Such measurement is the cost at the date when applying Ind AS to inventories or any other applicable standard. Therefore, in line with paragraph 13, the fair value less cost to sell. I hope this cost to sell is clear now. It is the additional cost that you will incur to sell this product. Okay, of the plucked leaves at the time would be the cost of such plucked leaves at the date of applying the Ind AS2. Okay. So how will you calculate it? You know, like if I want to sell these tea leaves, what will be the price from their existing kind of a condition? And that will become my fair value. What will be the subsequent measurement of such tea leaves in line with the Ind AS 41 and Ind AS 2? How will you value it further? Subsequently, such plucked tea leaves will be measured as inventory as per the accounting principles of Ind AS 2 inventories. Why it is inventory? Because you are using it. It is a raw material now for your further processing. Okay. So they will be considered as an inventory. Okay. We are, I think, halfway through and we have this last question. So we are pretty much on time. This is what I can say. In the process of preparing the financial statements for the financial year ending on 31st March 23, the management of the RTL has made several accounting estimates and affirmed to the auditor that all the necessary accounting estimates have been recognized, measured, and disclosed in the financial statements are in accordance with the applicable financial reporting framework. However, in the course of the audit, auditor has observed some changed circumstances giving rise to the need for an accounting estimate. Require enumerate some circumstances, change of which would prompt inquiries from the management of RTL. Right? So the company is of an opinion that all the accounting estimates for such type of transactions, for such type of industry, they have considered all of them while preparing the financial statements, and then they have very much explained them also in the financial statements. But the auditor is of an opinion that there might be some circumstances which can trigger the auditor to ask management about certain more accounting estimates which the management might have missed. Okay, so the question is asking that what kind of situations, circumstances, what kind of questions the auditor will be asking in those situations. Okay, so I mean, this is also explained. So you can also kind of ask the questions about the changes in the entity, changes in the laws, regulations, circumstances. I mean, that all is there because this all directly, indirectly may impact the accounting estimates that we have. So as per SA 540, auditing accounting estimates, including fair value accounting estimates and related disclosures, inquiries of management about changes in the circumstances may include, for example, inquiries about whether the entity has engaged in new types of transactions that may give rise to the accounting estimates. Any new type of transactions are there? That's the first question. Terms of transactions that give rise to the accounting estimates have changed. Okay. So earlier there was some terms in any of the contract or the transactions, and those terms have changed. And those terms might have given earlier a kind of an accounting estimate. So if those terms will change, the accounting estimates may change. Accounting policies relating to accounting estimates have changed as a result of changes to the requirements of the applicable financial reporting framework or otherwise. If there is change in the law, regulatory or other changes outside the control of management have occurred that may require the management to revise or make new accounting estimates. Okay. So there might be some regulatory changes also that may result, or they may push the management to have more accounting estimates or change the earlier accounting estimates that they had. New conditions or events have occurred that may give rise to the need of for a new or revised accounting estimates. Any new conditions or events. So the possibilities are basically the company has entered into new transactions, new segments, new product line, new service line. Maybe the accounting estimates on the basis of the circumstances which this was there, the circumstances got changed. Maybe there is an accounting policy changed. Maybe a framework, a reporting standard got changed. Maybe there is some regulatory environment updates or some kind of law requirements were there which got changed. So all this may uh, lead you to know that, or maybe to doubt that there might be some accounting estimates which are either not considered by management or not updated accordingly. So if these things have happened, you can definitely sit with management and ask about their assessments around this. And if they are not able to give you any satisfying answer, then probably their risk assessment process is not something which is working fine, right? So you need to challenge that risk assessment process as well. Okay, so this is how it is. So this is, I mean, one of the very beautiful case study I will say that I should really appreciate. I mean, this was very detailed and very good concepts. It was giving you some concepts around agriculture income, some taxation, some accounting or accounting estimates, right? Some TARs, Mendeley's law, value proposition. I mean, this was amazing. While going through this particular PPT, it helped me recalling as well a couple of concepts, which was, I mean, I read earlier, and on daily basis we are not doing everything. I mean, not everything is being practiced. So I'm really happy that this is what I have gone through. So now I'll go back to probably Mr. Dharmendra or Deepak ji, and I may request a break for like 10 minutes or something, and then we can start with the second case study of the day. Going back to Dharmendra ji, you.
Yes, sir. Yes, sir. You may take break, sir.
Okay, so I'll see. Yeah, I'll see you in 10 minutes then. Looking forward to discuss a second case study, which is also equally important and really interesting. See you soon, guys. everyone. In the second part of today's session, in this, we are going to cover another case study. And this case study is all about kind of an entrepreneurship that we are seeing all around, Make India kind of an initiative. So, this is how the economy is progressing after the pandemic, when the economy confronted the pandemic and all. So this is a kind of again another real life scenario. So IBS is all about practical. IBS exam is actually all about the kind of real life scenarios. And don't consider these exams. I mean, we are a professional body. We are going to be professional. So don't consider them like exams. This is what I generally tell. So these are the case studies. This is actually a client which is coming to you with couple of situations, and you as a professional, you have to address it. You have to tell them the scenario, the solution, and the kind of value addition. As a professional, all you need to do is to either solve problems or do value addition. If you cannot solve problems or you cannot do value additions, then it will be very difficult to establish ourselves in the society as a professional. Okay, so this is not a case study, I will say. This is kind of a practical situation that one of your client is facing, and how are you going to respond to them? How are you going to solve the problems that they are coming to you with? Okay, so let's understand the client's problem first. So, economic survey for 23-24 has been presented to the parliament. According to the survey, the Indian economy, however, appears to have moved on after its encounter with the pandemic, staggering a full recovery ahead of many nations and positioning itself to ascend to the pre-pandemic growth path. Okay, so it says that we are now growing up, we have come out of the pandemic impact, and now we are progressing. We are doing much better than couple of nations. It is also stated that agencies worldwide continue to project India as a fastest growing major economy. So this is showing how at a world stage the impression about India is, how the other countries are seeing us. Now, this could be possible with team. So together everyone achieves more. This is the full form of team. So whenever we talk about a team, the team's full form is exactly this, that together everyone achieves more efforts. The participants of the team are the, so when we are saying that we all as a team in the economy, we can accelerate, we can grow faster than what we are thinking. We have set ourselves some standards, some targets for as an economy, and we can beat those targets, we can go beyond them. This is only possible to work when we will be working as a team. So who are the part of team? The part of the teams are the central government, the state government, the industries, and the people of the country. Now, there has been a tectonic shift in the policies of the government. The emphasis of the present government has been to stimulate entrepreneurship so that more and more people become a job giver rather than job seeker. This is what I was telling you. Make in India kind of an initiative. This has also resulted in providing impetus and encouragement to the youth of the nation to pursue their entrepreneurial dreams. One such case of entrepreneurial dreams is of Manu and Tanu. So there are two friends, Manu and Tanu, who always aspired to have their own business ventures when they complete their education. They both completed MBA from top business schools in India and were working in large corporates with big pay packages. Whilst they always wanted to pursue business ideas, nothing came their way which enticed them to start their entrepreneurial journey. Meanwhile, Manu, who was interested in economic policies and defense related matters, came across a write up which described the shift in the policy by the present government in defense sector. The new policy emphasized, okay, it emphasized on giving priority to the indigenous market players and reserving more than 500 items for domestic manufacturing. So this new policy came up, and the Indian government reserved around 500 items categorically for the domestic, the indigenous market. It means the FDIs will not be allowed, the foreign participants will not be there, the competition will be less, and it will be a big opportunity for the Indian manufacturers. And it seems like a lucrative business chance, he thought. Manu is thinking that this is a good chance. Though Manu and Tanu were in contact, it had been couple of years since they met. Manu met Tanu and discussed this idea of business potential. And this is what exactly we say, that a lot can happen over a cup of coffee. So they had a coffee together, and Manu discussed about this particular business idea with Tanu and how they could start something of their own. They believe there is a lot of scope in domestic as well as in the global market if they could manufacture the ancillary items used in defense equipments. Okay, more than 500 items were there. So they must pick up some items which are the ancillary items in the defense equipments, and then they can start selling them in the domestic and in the global market. Having realized their true calling, both resigned from their high paying jobs to start their own venture. In 21, they incorporated a company called M&A Private Limited, with both of them being its shareholders and directors of the company. Okay. Now they both are the shareholders and the directors. Gradually, when the business started growing, they bought in Sham. Okay, another very important character in the game. Sham is there now. Sham as a shareholder and the director. So Sham also became a director and a shareholder. Presently, Sham holds 12% of the equity share capital, while Manu and Tanu holds 44% each. Okay, so 44% each means this has become 88% and 12% is with Sham. This is how the setup has been created. As both Tanu and Manu had business acumen and strategic vision, they wanted to rely on a professional who can guide them on accounting, law, and compliance matters and give expert advice at various points in time as required by the business. You see, I always, whenever I come across, I always tell people, especially the ones who wants to create a business, I always tell them that they should arrange bail, okay, BAIL, before they plan about a business. They should think about bail, and when people start smiling about bail when they heard about it, and then they ask me back that what is the bail when we are talking about a business here. So for me, the bail is very simple, which is B is actually a banking partner. You have to find a very good banking partner who can help you in the time of financial crisis. Okay. The A stands for accountant, a very good accountant, an advisor. Very, very important. The one who can give you some advices in terms of financial advices, business advices. It means some consultants. And then the other A is for auditors. So you should identify very good accountants, auditors, and advisors for your business. I is for insurance. Okay. In the last case study, we saw the impact or the benefit of having an insurance. When the green tea leaves were destroyed by a hailstorm, the insurance company paid 10 lakh rupees to them. So insurance is very important. And then the L stands for legal, which is the lawyers and the legal environment. So any business, if they really want to kind of stand and then they grow and make it an autonomous, independent business, the bail has to be there. Definite a banking partner, an accountant, an advisor, an auditor, an insurance company, insurance of the business, and the legal partners. Very, very important. So since they had business acumen, they also instantly realized that they need somebody, a professional who can guide them on accounting, law and compliance matters. And what happened? They appointed their longtime friend and a tenured financial professional. The name of this guy is Ajim, as the CFO of the company. During one of the board meeting, while briefing about the audit status, the CFO, it means the Ajim, informed the directors that the financial statements for the current year would be prepared as per the Indian accounting standards. In the audit kickoff meeting, which is held in March 24, the following points were discussed by CFO, while Tanu and Manu added their insights. So these are a couple of points, and the questions and answers will be based on them. So we need to be very careful while reading them. Sham is the director. So you can recall Sham was all holding 20% of the equity shares already of the company, as Sham had some financial emergency. Tanu and Manu wanted to support him by giving a loan. Okay. So they wanted to give a loan from the company. CFO mentioned that the company had an accumulated profit of 7.5 lakh rupees. This was the profit. 5 lakh rupees was required by Sham as a loan. 7.5 lakh was available. It is pertinent to note that Sham is also a partner in Shamlal and Company. So there is another company, Shamlal and Company, and Sham is along with the directorship in this company. The Shamlal and Company is also there, where he has 30% sharing. right? So there is another company. This may be a related party because company has made an advance of 2 lakh rupees to the Shamlal and company as well, but this was for procurement of material. Okay, so 2 lakh rupees was already given to a company where a substantial interest was there with Sham, and Sham needs 5 lakh rupees, right? So we need to think through because he has 12% equity shares as well. Now, in the second situation, the company also purchased goods from entities registered under micro, small, and medium enterprise. CFO of the company provides the following information. So, CFO is saying that the MSME dues are like this, that 7 lakh rupees is not due, okay, out of which 3 lakh is disputed. Due less than 1 year, 12 lakh rupees, out of which 2 lakhs are disputed, and 1 to 2 years, 3 lakh, the whole amount is disputed. More than 2 years, there is nothing in the books. During the year, the company paid an interest of 2.5 lakh rupees in terms of Section 16 of the Micro, Small, and Medium Enterprises. So, if you're not making the amount within the due period, then the MSME Act says that you have to pay some interest as well. And the company has paid 2.5 lakh rupees interest last year for these kind of cases. The company has also made a payment of 1.5 lakh rupees, right, which is delay than the day it was supposed to pay. And there was an interest which was due 10,000 rupees. The company has not paid that interest. Okay. So 2.5 lakh rupees of interest is given, 10,000 was not paid. In a third situation, MNA Private Limited acquired 100% of the shares of another company, PNT Private Limited. The negotiations for the acquisition commenced on 1st January. Okay. So they commenced the negotiation on 1st January and the agreement was finalized on 1st March. Agreement was finalized while MNA Private Limited obtained the power of control PNT operations on. So be very careful. The power to control was this. The agreement states that the acquisition is effective from. So agreement is saying that the agreement is effective from 1st January. And the M&A Private Limited is entitled to all profits after that date. So the company will be entitled to profit from January to March for this year if I'll talk. But the day they started the controlling the whole company is 1st of March. In addition, the purchase price is based PNT's Private Limited's net asset as at 1st January. The final settlement it happened on in May. So the compensation was paid in May, but the net assets for the calculation they were taken from 1st of January, but the controlling power came to 1st March. I hope this situation is also clear because we may have a question around this situation as well. M&A Private Limited also holds 70% stake of issued equity share capital of Sage. Now you see, there is another company in which we have 70% of the stake and 45% of the redeemable preference shares. So we are having 70% of the equity capital and 45% of the redeemable preference shares. The acquisition was made on 31st December. Okay. So during the year 31st December, after 9 months have passed, it means the end of the ninth month, 31st December, issued and paid up equity and preference share capital of Sage Limited as on 31st March 23 is rupees 15 crore and 5 crore. This is the issued and paid up equity and preference share capital was 15 crores and 5 crores. Balance in the statement of the profit and loss for the year 31st. So the complete year's profit is 25 crore rupees. But this 15 crore and 5 crore is actually on the date of 31st March 23. So for the year 23-24, the profit which is there in the financials is 25 crores. All the book values of assets and liabilities were same as their fair value, except for an item of the property, plant, and equipment. So the books which are made, they are made even on the historical concept basis, but they reflect the fair value as well, except one PP&E, plant and equipment, whereby the carrying amount at the time of the acquisition by the M&A Private Limited was PP&E 3 crore rupees. So on the day which is 31st December 23, okay, very important day, the book value was 3 crore rupees, but the fair value of this asset was 6.2 crore rupees. It means there is a gain in the value. So obviously, when the company would definitely like to to be compensated for this acquisition, they would definitely like 6.2 to be considered as a compensation instead of 3 crore rupees. No adjustments for fair value has been done in the books of the Sage Limited. So they are not making any fair value adjustments because they think, so we always have to be conservative as well in certain approaches, because it is the premium, the fair value is being valued. So in these cases, the adjustments are not done in the books for the time being. The next condition is Anu is also a director of M&A Private Limited. So there is another director now, Anu, who was going on a world tour for a period of 5 months. So they are going on a world tour for 5 months. In his absence, he wishes to appoint his friend Kumar as an alternate alternate director. Okay. So now for 5 months and wanted to appoint an alternate Kumar. With many private limited enters into a 7-year service contract with a customer NP Limited for an amount of 21 lakh rupees, 3 lakh rupees per year. So every year, per year, they are like 3 lakh rupees per year. The standalone selling price for 1 year contract at inception of the contract is 3 lakh rupees. Okay. So if you will look at this particular situation, you will realize that the standalone contract as well. And then they have signed it total amount. MD Private Limited accounts for the contract as a series of distinct services. So they have started accounting it like every year it is a kind of a series of distinct services. So 3 lakh rupees per year for 7 years. At the beginning of the seventh year, the parties agreed to modify the contract. Now there is a modification of the contract. So what happened? The fees for the seventh year, which was supposed to be 3 lakh rupees, it got modified to 2.7 lakh rupees. Okay. So there was some reduction in services or because of any XYZ reasons, or maybe the market value changed or competition increased or whatever. The seventh year fees was reduced to 2.7 lakh rupees. NP Limited agrees to extend the contract. So NP Limited they agreed like this contract can be extended for 7 more years. And they agreed to an amount of 16.8 lakh rupees, which was 2.4 lakh rupees per year. It means the contract which was originally signed at 3 lakh rupees now got reduced to 2.4 lakh rupees per year for next 7 years. So the seventh year's price got reduced to 2.7 lakh. And for the next 7 years, another contract was signed at 16.8 lakh rupees, which is 2.4 lakh rupees per year. But what we need to note is that the standalone selling price for 1 year of services at the time of modification, so, like earlier, when the contract was signed, the standalone per year's value was also 3 lakh rupees and it got signed for 21 lakh rupees. Now the situation has changed. Even though we were able to sign it at 2.4 lakh rupees per year, the standalone selling price for this contract is 2.10 lakhs only. It means the company is getting paid for the relationship that they have built over the years, or it is not exactly like operating as a different contract, and then this may be considered as an extension to the existing contract itself. So we need to understand the modification of contracts as well, because the revenue recognition will be totally dependent on them. If this is a kind just an extension of the existing contract, the comprehensive or cumulative catch up will come in picture. I will discuss this when we will discussing about the solution. But yes, you need to understand the modification of contracts because it is going to impact the way the revenue will be recognized in the books. Okay, moving ahead. Okay, now the questions have started. So I hope the situation is pretty much clear. This is the complete situation the company is in right now. Let's discuss the questions one by one. The first multiple choice question is, the CFO says that the tax auditor wants to treat the loan of 5 lakhs to Shyam and advance of rupees 2 lakhs to Shyamlal and company as deemed dividend. Is it appropriate? The first option is, both the loan of rupees 5 lakhs and advance of 2 lakhs will not be treated as deemed dividend as both are repayable. So the first option says that they are not the deemed dividend, because they are ultimately to be repaid. Okay. Now, the second option says that loan of rupees 5 lakh and advance of rupees 2 lakhs will be treated as deemed dividend only to the extent of rupees 90,000. That is 12% of the accumulated profit. So they mean the this particular person was holding only 12%. So it is 12% which what will be deemed as dividend. Both the loan and advance will not be treated as deemed dividend, as his interest in the company is only 12%. So they are saying the interest in the company is not substantial. So it is only 12%, so it will not be considered. The third option says that the loan will be taxable as deemed dividend, but the advance given to the Shamlal and company will not be treated as a deemed dividend since it's a business advance. Okay. So I know this is basically the answer D is the correct answer, but how this answer is correct is something we can definitely see in the solution. So it has a detailed explanation. Okay. Uh, okay, just a minute. Okay, perfect. I hope it is visible and it is readable as well to all of you. Now you see the answer is D only. We were pretty much sure. And why is it so? Because the 2 lakh rupees of the amount that is given is basically a business advance. It is there to procure some raw material or something, and it is given against it. It is not given for the benefit of that particular director itself. But when we are talking about this 5 lakh rupees as a loan given to the director who is holding around 12% of the company's share, that this will be treated as dividend. The loan will be taxable as dividend, but the advance given to the Shyamlan and company will not be treated as deemed dividend since it is a business advance. If you go through the reasoning, you will realize that there is a section of the Income Tax Act. Dividend includes any payment by a company not being a company in which the public are substantially interested of any sum made after 31st this date by way of advance or loan to a shareholder, being a person who is the beneficial owner of the shares, holding not less than 10% of the voting power or to any concern. So it is not less than 10%. It means the Sham is having 12% of the company's shares, so he's holding 12%. Hence, so I'll just jump directly to the conclusion. Hence, the loan to the director will be treated as deemed dividend, and an advance from the firm will not be considered as deemed dividend, as it is just a business advance. I hope this is clear, right? This is what we discussed, because in this given scenario, this is the case. The second question is uh, about CFO states that the interest paid to the, okay, so this is the MSME Act and the interest paid to the MSME vendor. So MSME vendors is allowed as a business expenditure and should be reported accordingly in the tax returns. So it says like A, the interest of 2.6 lakhs will be deductible as it's a business expenditure. Hmm. The interest of rupees 1.95 lakhs will be deductible as 75% of the interest paid to the MSME vendor will be allowed at deduction. Second option says 75% is available. The interest, third option is of 2.5 lakhs paid to MSME vendors will not be allowed as a deduction from computation of income, as the MSME Act specifically prohibits such a deduction. So it says that the MSME specifically denies that you cannot claim any interest that you have paid to MSME vendors as expenditure in the income tax, right? While calculating, it is not an admissible expense. Okay. Now, D says the interest of rupees 1.25 lakhs will be deductible as 50% of the interest paid to the MSME will be allowed at deduction. So B says 75%, D says 50%, C says 0%. It is not at all deductible, while A says it is 100% business expenditure. So you need to know about the MSME Act, and then MSME Act specifically, they explicitly it is mentioned any interest that you are paying which is under this particular act because of the compulsion of this act is an inadmissible expenditure. So you cannot claim this as an expenditure while preparing your income tax return. So the answer for this is so this 103. What is the date of acquisition of the PNT Private Limited by M&A Private Limited for the purposes of business combination? So if you can recall, 1st January 23 was a day when the negotiation started, and it is the day also from where or from this date the profits will be accumulated, profits will be shared or distributed to the new owner as well. 1st March 23 was the date on which the company got the controlling power of the company. The C was either of 1st January or 1st March as the choice of M&A, and D is 1st May 23. 1st May 23 was a day when the compensation was paid. Okay. The law is very clear. It says the moment, the day on which you got the control is the day on which the business combination will be considered to has happened. It is not the closing date. Okay. It is the control transfer date. Okay. Closing date means the agreement got signed or the compensation was paid. It has no relevance from this particular perspective. It becomes very challenging when you will do in the practical scenarios, practical life, because you will realize that this generally does not happen in one go. So one of the company that I was a part, we were as working as an auditors, there was a step acquisition that happened. So during the whole year, the company kept on buying the shares of the other company. Okay. So initially it was just an investment. Then the company was able to purchase more than 5%. Then it became an associate of the company. At a later stage, it was able to buy more than 50% shares of the company. It became a subsidiary of the company. I mean, so we have to prepare 3 4 financial statements of a company for respective period. In for a couple of months we have to treat it as an investment. For the next couple of months we have to just treat it as a probably an associate, and then it's a subsidiary. So we need to see that at what moment we have got the control. Okay. So these kind of scenarios are always available. I mean, when you will read about the holding and the subsidiary companies concepts as well, this is step acquisition, etc., is already mentioned it. But doing it practically obviously gives you more exposure to this. But for from here, we are very clear with the question that 1st March 23 was the day when the control, the ownership was being transferred. Fourth is basically compute the amount of non-controlling interest of Sage Limited. So we need to calculate the NCI. NCI is basically the minority's interest or minority share in the company. So if you can recall, in the Sage Limited, we had around 70% of the equity holding. So that 70% is what is my holding, and then the 30% is what the holding of the minority. So if I have to calculate the NCI, which is non-controlling interest, then that will be the 30% when it comes to I had around 45% when it came to preference shares. So the 55% remains the non-controlling interest from a preference share perspective. So if you will do a calculation, over here is kind of a judgmental, I will leave it to your judgment, but I will still is available. Profit is available at 25 rupees. It's available in foods. This basically all there was PPT which was in the books was at 3 crore rupees, but actual value at that was 6.2 crores. The additional 3.2, which is not recorded, that's also part of NSI. That additional 3.2 is not part of it interest only. So that's not an NCI. Only 30% what is an NCI for the fair value adjustment. If NCI 30%, the income it will be 4.5%, 55% because I'm holding only 45%, 0.75. So profit which can book for the company is 25. NCI calculation. And then I was explaining how we have calculated the NCI. Yeah. So here comes the fair value adjustment. This 3.2 crores, which is the additional amount, which was not a part of the books. So 3 crores was the book value, and then the 6.2 crores was the fair value. Now this 3.2 crores, which is the additional fair value, if we need to have this 3.2 crores as well as a part of the NCI, then 30% will be allocated to NCIs because 70% will belong to me. Now, if we are doing this 3.2 additional fair value, then this 3.2 will also be subject to the depreciation because for one quarter, if you see, we purchased this on 31st December. So 3 months of interest will also be there. So what we need to do, we need to calculate 3 months of depreciation and we need to do the adjustment for that NCI as well. Now, how this 3 months of depreciation is calculated, it is kind of it will depend on case to case. You may end up calculating this 0 0.1 as 0.08 as well, but whatever calculation you have. So let us suppose if you are saying this will remain for 10 years, 3.2, then this can be like 32 lakhs per year will be the depreciation, just to give an example. And then you can say that for one quarter, the depreciation can be 0.8 lakhs. Okay. So this depends 0.08 lakhs, sorry. So it depends. So my request will be if you are handling any such kind of instance in the question paper, whereby you think there might be more than one answer or it is dependent on some judgments, you can make a note of it. You can do a star marking, and then at the end you can explain your assumptions, that what is the assumption that you have taken to calculate this particular thing. Okay, that is always advisable. Now coming back to the next question. The next question is whether Anu has the right to appoint alternate directors in his absence. So if you can recall, Anu was going on 5 months long-term leaves, and then she decided, or he decided, I think, that he can appoint his one of friend Kumar as an alternate director because it is already permitted by the association, articles of association. So the options that we have, whether Anu has a right to appoint alternate directors in his absence. The options are: claim made by Anu to appoint Kumar as alternate director is valid, as the Articles of Association of M&A Private Limited provide for appointment. So they are saying the articles is providing for the appointment, so Anu can provide. The second is basically claim made by the Anu to appoint Kumar as alternate director is not valid, as the authority to appoint alternate directors vests with the board of directors only, and that too subject to articles of association. Third is Kumar cannot be appointed as alternate director in place of Anu, since his absence will be of less than 6 months. And the D is Kumar cannot be appointed as alternate director in place of Anu, since his absence will be more than 3 months. So in these kind of questions, this is what exactly I was discussing when we completed the first study as well, first case study as well, that you will realize that in one case study only, you will have to kind of knowledge of various subjects or various concepts. Like this came from directly from the directorship or director as a segment from the Companies Act. So you need to be aware that who can appoint alternate directors in this case. In this kind of a scenario, the even if the articles of associations are allowing, the power of having or appointing an alternate director, it vests only with the board of directors. So Anu is never in a position to appoint this as a director, Mr. Kumar. So he has to route it through the board of directors meeting only. Claim made by the Anu to appoint the Kumar as alternate director is not valid, as the authority to appoint alternate director vests with the board of directors only. Then to subject to articles of association. Section 161 of the Companies Act is very clear that the board of directors to appoint any person as an additional or alternate director and not to the director during whose absence he is to act. So Anu is never in a position. Okay. Coming back to the next question. Now they are descriptive questions. Okay, so we need to understand for a descriptive question, you have to have all the logics, all the concepts, and the understanding of the law, and then you have to explain them in detail. So whatever decision or whatever answer you are planning to give, again, why I'm saying decision or the solution, because it's not a case study from my perspective. It is more or less like what your client is facing on ground, and then you are trying to solve it. So the sixth question, or basically a descriptive question for you, is as Tanu and Manu are not well versed with the Ind AS with reference to business combinations, they want to understand about determination of acquisition date and ascertainment of the control. So obviously, determination of the acquisition date is a date on which the control is ascertained. Okay, and on the day the control is ascertained is the day when the ownership is transferred, when your decision makings will start impacting the decisions of the company. So you need to make Tanu and Manu understand that what will be the date of acquisition, how you are going to determine it. And when you are saying that the acquisition date is a date on which you ascertain the control, they would also like to understand that what is the ascertainment of control. What do you understand by it, right? So in both the cases, you have to explain. So determination, we discussed this earlier as well, so I'll just simply read it for the benefit of everyone. But determination of acquisition date is simple on the day when you got the ownership control. Okay. So paragraph 8 of the IND AS 103 provides the acquisition date as the date on which the acquirer obtains control of the acquiry. Right? So it is the control transfer date basically. It's not the compensation transfer. It's not from the day you started getting the benefit or the profits of the company. It is the moment, the day on which you got the control of the company. Clarifies that the date on which the acquirer obtains the control of the acquiry is generally the date on which the acquirer legally transfer the consideration. Okay, acquires the assets and assumes the liabilities of the acquiry, the closing date. Okay. However, the acquirer might obtain control on a date that is either earlier or later than the closing date. Okay. So closing date is a date when the settlement is happening. Liabilities are, the compensation which is determined is being paid. That is what is your closing date. But when you are talking about the control transfer date, it may be earlier or later than the closing date. For example, the acquisition date precedes the closing date if a written agreements provide that the acquirer obtains control of the acquiry on a date before the closing date. The acquisition date is a very important step in the accounting and business combinations because it determines when the acquirer recognizing and measures the consideration, the asset acquired, and the liabilities assumed. The acquiree's results are consolidated from this date. The acquisition date materially impacts the overall acquisition accounting, including post-combination earnings. Okay. So why it is important? I just gave you an example of a step acquisition. Let us suppose the company is continuously buying the shares and slowly was able to gain the control over the other company. Now, if you see, till the moment the company had no control over the other company, it will be very difficult to do the accounting, let us suppose, as a holding and a subsidiary company. Okay, just to give an example, the moment it is established that the company started controlling, or now the decisions of this company can start impacting the decisions of the other company, is the moment since when you can start doing the subsidiary accounting for that company. Otherwise this may remain as a maybe just an associate, or maybe just two companies, or a simple investment. And if it is an investment only, then it is not like a subsidiary accounting that you will be doing. Then it is just like investment accounting. The whole of the scenario will change. Okay. So it is definitely a control transfer date may be different than a closing date. A closing date is just a date on when the deal is finalized. Ascertainment of control. How do you know what is the control transfer date? So paragraph 6 of Ind AS 110 Consolidated Financial Statements states that an investor controls an investee when it is exposed or has right to variable returns from its involvement with the trust investee and has the ability to affect those returns through its power over the investee. In simple words, so if you say they can affect those returns, it means, in simple words, I mentioned the decisions of my company can start impacting the decisions of other company. It means if I'm taking a decision about that company and that company's decision is getting impacted, which means ultimately their returns are getting impacted, then that date, that moment since when that kind of level of control is with me, is the date when I gain the ownership or I gain the control. Further, para 7 of the Ind AS 110 states that an investor controls an investee if and only if the investor has all the following. So this is how they establish, right? How the ownership transfer will be established is that I have the power over the investee, exposure or rights to variable return from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor's return. Okay, so these conditions are they are met, then it means the ownership is transferred. Okay, the control is ascertained. So again, in simple words, how we see in the practical environment is basically the moment my decisions are impacting the movement of the investee, I have ascertained the control over it. It can be different than the closing date. Be very careful because at times people think the closing date is actually a date on which the control is ascertained, but that's not true in all the cases. Okay. We'll move to the next question. It is about the CFO. Now, CFO believes that a loan to the directors is prohibited under the Companies Act 2013. Can M&A Private Limited extend the proposed loan to SHAM? So, CFO is of an opinion that the directorship is prohibited. We cannot give the loan. But can M&A Private Limited extend the proposed loan to the SHAM? Comment. There is an exception. So, when you are answering these kind of questions, I'm pretty sure when you will start going through the scenarios or the concepts, you know that these kind of conditions or exemptions are available, and then you know where to look into while attempting these kind of questions. If you see there are certain conditions, if they are met, then you can extend the loan to the director as well. Now, Section 185 of the Companies Act says that imposes restrictions on the company on providing of loans to the directors of the company as per the exemptions notified. So there is an exemption by the MCA. Section 185 of the Act shall not apply to a private company in case of fulfillment of the following conditions. If these conditions are fulfilled, then probably this will not be applicable. A, in whose share capital no other body corporate has invested anything. So in our company, MNA, there is no other body corporate who invested any money. So this MNA invested money into other body corporates. There is nobody who invested money. If the borrowing of such a company from banks or financial institutions or anybody corporate is less than twice of its paid up share capital or 50 crore rupees, whichever is lower. It means the borrowings are not that big. Okay. Because if you are giving loan to your directors by borrowing it from the outside market, it's a very risky affair, right? So you're just taking money from the outside and then giving it to your directors. If that is not the case, like your banks or financial institutions loan that you have taken is less than twice of your paid up share capital, then also the risk is not that much there. Such a company has no default in repayment, and then you are not doing a default. So it means there is an amount which was due to be repaid. You are not repaying that amount, but you are giving that amount to your directors. Then also it is not allowed. So if there is a company who has kind of satisfied all these conditions, then they can still extend loan. They can still provide loan to the directors. In the given case, since the company M&A Private Limited is in compliance with the above mentioned criteria, so it will be exempted from the applicability of Section 185 of the Act on it. So the restrictions marked on providing of loan under Section 185 of the Act will not be applicable on M&A. Hence, M&A Private Limited can extend the proposed loan to Shah. So it is not like restricted. It is exempted with certain conditions. If these conditions are fulfilled, you can still give it to director. The last question for the day, I think we are very much on time. The question is the CFO wants to understand how to record revenue at the end of the seventh year as per IND AS 115. Also, prepare a brief note explaining the accounting for revenue when the contract is modified. So, now this is the modification of the contract. Okay, especially how the cumulative catch up will be calculated and how the true ups will be happening. I'll give you a kind of a practical scenario first of all before moving to this particular point. I'll try to explain it with a practical situation that we have recently encountered. So we have been facing a situation. One of our client actually faced a situation whereby they came under a comprehensive long-term service agreement with one another company. Okay, so there was a customer, right? And another company was a customer. Just to give an example, let us suppose a contract of AC repair services, or I mean, it was obviously a very big contract, but I'm just giving you a simple example. So let us suppose if there is a comprehensive agreement whereby the AC is repair. Let us suppose it is being covered under that particular agreement for 10 years, even if there will be a product that needs a replacement or if there is a service that has to be happened, everything, it's a composite kind of a contract for a long term. And then you have charged an X amount, okay, from the customer. So let us suppose the for 10 years you have charged 1 lakh rupees, giving it to like 10,000 rupees every month in one or the other way. Now the problem is that you don't know how to recognize the revenue of this particular 1 lakh rupees. Because you see what is happening over here, even though this 1 lakh rupees is there, now the point is this 1 lakh rupees has to be spread across 10 years. But the problem is that for the initial years, the maintenance will be low, right? If you can understand this, for the initial, because the AC is new, all the parts are new, so the expense will obviously anyone with a sane mind can tell that initially the expenses will not be there, the repair expenses will not be there. So if you will be recognizing 10,000 rupees of a revenue evenly every year for 10 years, this might be a wrong kind of a situation. So what you need to do is basically, since this is 1 lakh rupees that you have got from the customer against the repair, so it will be more logical if we will be recognizing the revenue as the repair cost will be there. So what you need to do, I mean, we're just talking about a little wide over here. This is just a food for thought, but practically we do that. That if in case of, so this is a very simple example, and the amount is also not that big. So even if you'll go evenly, it will not make much difference. But practically for bigger contracts, where might be like millions of dollars of contracts can be there. What is generally suggested that you will be doing a kind of an accounting basis the cost that you are incurring. So let us suppose if this 1 lakh is the total kind of a revenue that I'm expecting from this project, and then the total expected cost for me is around 75-80,000 rupees. It means I'm sitting around 80% of the cost of this particular contract, which means 20% will be my margins. So what I need to do is basically to see that for first month, for first year, how much cost is getting incurred. So in the first year, if let us suppose out of that 80,000 rupees of total cost that I was expecting, in the first year only 5,000 rupees of the cost is there, right? So instead of recognizing a revenue of 10,000 on the cost, the expected cost of 8,000 per year, now we will be only recognizing a revenue according to the 5,000 rupees of a cost. Okay. Now, this is how the first year revenue will be booked. Let us suppose in the second year, the cost increased from 5,000 to 7,000 rupees. Now, the revenue will be booked according to 7,000, or I will say 12,000 rupees of a total cost. So, 5,000 was booked in the first year. Now, till the second year, we need to recognize 12,000 rupees of a cost. Okay, and so on. This is what, and this is known as cumulative catch up. So what I was not able to recognize in the previous year, so let us suppose I have recognized only revenue against 5,000 rupees of a cost. Now I have to recognize the total. I have to put the entry for cumulative catch up, which is, let us suppose, for the until the second year, if I have to do the costing got incurred was 12,000 rupees, then I have to recognize the revenue according to 12 lakh rupees, 12,000 rupees, and whatever the revenue that I have incurred or booked in my previous years, that is what I need to reduce it, right? So whatever the extra revenue that was supposed to be booked for this particular contract, that will be booked in this year. I hope I hope this is not confusing. I know practically this becomes pretty confusing, but this is the concept of modifications of contracts or cumulative catch-up kind of a concept. So since this is a very important kind of a situation, so I'll take you back to understand this much in detail. And this M&A Private Limited enters into a 7-year service contract. So be careful when they entered into this kind of a contract. 21 lakh rupees was the total cost that they initially planned. Oh, sorry, revenue is what they planned. And since it was 3 lakh rupees per year, so it was very simple. It is not a composite contract with 7 years in 21 lakh rupees. They have very specifically mentioned that this is 3 lakh rupees per year. So revenue recognition is very easy in this kind of a situation. Okay. All you need to do is to book the revenue of 3 lakh rupees every year. But after booking 18 lakh rupees of a revenue, now you realize that in the seventh year, the revenue is, you cannot just book 3 lakh rupees more, because now it has actually reduced to 2.7 lakh rupees. Now, while you are planning to renew this particular book this revenue of 2.7 lakh rupees, you realize that the contract is also extended. So now when the contract is getting extended, you need to think whether this is a new contract or an existing contract extension. Is the existing contract is giving you some additional benefits in terms of renewing this particular contract, or this is a separate contract? So if this is a separate contract, how you will recognize the revenue in the seventh year? You will recognize the revenue as 2.7 lakh rupees, because the new contract is a separate contract. But in this equation, we can definitely see that the contract was an extension of the existing contract, and that too because of our existing relationship, because of our existing services to the client, we are able to sign it up with 2.4 lakh rupees per year instead of its market standalone selling price 2.10 lakhs. So it means the benefit that we are getting is we are getting because of the services that we are already giving to the client. It means for the seventh year's revenue is not 2.7 lakh rupees. What I need to do is to do a cumulative catch up. So the total kind of a project value will become this 21 lakh rupees, which was initially 18 lakh is already booked. Now 2.7 lakh rupees is supposed to be booked in this year. But the problem is now it is not 2.7 lakh rupees for this year. I have another revenue, which is there 16.8 lakhs for the next 7 years. It means for this year and the next 7 years, I'm going to earn 16.8 plus 2.7, which is how much? 19.5 lakh rupees. Okay. And this 19.5 lakh rupees, it is one composite contract So I have to divide this in 8 years, this year and the next 7 years. So this is just an extension and the cumulative catch up. So initially I was booking 3 lakh rupees. Now whatever difference is there, I will hit my P&L with that much of amount. Okay. So let's go to the solution. I hope this modification of contract you were able to understand. So I'll just read this. Maybe will take 2 to 5 minutes, and then I'll give it back to Deepak ji for final closing. So if you see the recording of the revenue at the end of the seventh year as per Ind AS 115. In the given case, even though the remaining services to be provided are distinct, the modification should not be accounted for as a separate contract. Okay, because the price of the contract did not increase by an amount of consideration that reflects the standalone selling price of the additional services. So the contract price does not seem like an additional services being given. It is just like an extension of the current services. The modification would be accounted for from the date of the modification as if the existing arrangement was terminated and a new contract created on the prospective basis because the remaining services to be provided are distinct. M&A Private Limited should reallocate the remaining consideration to all of the remaining services to be provided. That is the obligations remaining from the original contract and the new obligations. M&A Private Limited will recognize a total of 19.5 lakh rupees, 2.7 and 16.8 over the remaining 8 year of service. 1 year remaining under the original contract plus 7 additional years. So for the current year, the revenue will be recognized at 2.44 lakh rupees. It is not like 2.7 lakh rupees or 2.4 lakh rupees. Okay. This is, I think, what I explained. So this was the first part. The next is also prepare a brief note. Okay. A brief note on the accounting. Okay. So we can go along with, and this is what is actually explained when I discussed about this particular scenario, but let's see what is written in the law. So paragraph 18 to 20 of the Ind AS 115 deals with the contract modification. It provides in certain circumstances to treat it as a separate contract. A contract modification is a change in its scope or price of the contract that is approved by the parties to the contract. A contract modification is a change in the scope or price or both of a contract that is approved by the parties to the contract. The contract modification exists when parties to a contract approves a modification that either creates a new or changes existing enforceable rights and obligations of the parties to the contract. A contract modification could be approved in writing by oral agreement or implied by the customary business practices. If the parties to the contract had not approved to the contract modification, the entity shall continue to apply this standard to the existing contract until the contract modification is approved. Okay. Accounting in the modification for the modification. Once determination of contract being modified is established, the entity further determines its accounting either as a separate contract or as a termination of the old contract and the creation of a new contract by making a cumulative catch-up adjustments to the original contract or a combination of the two. An entity accounts for a contract modification as a separate contract if the modification increases the scope of the work promised under the original contract by adding new promised goods or services, and the increase in the contract price reflects the standalone selling price of the additional goods and services. So separate contract will only be recognized when these two conditions are satisfied. If a modification adds a distinct good or services to a series of distinct goods or services that is accounted for as a single performance obligation, the modification is accounted for as a separate contract as long as the transaction price increases by the standalone selling price for those added goods or services. So it simply says basically that a separate contract can only be there when these two conditions are satisfied. Otherwise, it will be considered as a modification of the existing contracts, and then through using the cumulative catch-up, etc., you have to mark up the revenue accordingly, which we have done in this particular case. In the first part of the question, we have recognized instead of 2.7 lakhs or 2.4 lakhs, we have recognized a revenue of 2.4375 lakh, which is the remaining amount is divided in 1 year of this year and the 7 new years that the contract got extended for. Okay, so I hope it was pretty much clear now, and I'll give it back to Deepak ji. And I thoroughly enjoyed this case study as well. This modification of contract was really very important for an understanding of everyone's perspective. Over to you, Deepak ji.
On behalf of everyone here, I would like to sincerely thank CA Amit sir for taking time out of his busy schedule to be with us today. We truly appreciate the way you explained how tax laws, financial reporting regulations, and business strategy are linked together when a company wants to grow in a responsible way. Your examples made it clear that real business decisions are not about one subject alone, uh, but about looking at bigger picture. That is exactly what the integrated business solution paper is designed to teach us, to connect knowledge from different areas and apply in practice. Sir, your insights have given us clarity and confidence, and we are grateful for your guidance. Now, students, this is time to put forward your questions. Let me give you some guidance because your exams are approaching. Okay, now I am discussing with you about strategic approach to handling IBS case study in your exams. Okay, the first step in approaching the IBS case study is to scan the entire case study in one go. The initial reading helps you determine whether you are able to handle the concepts which are being tested. Okay, remember you have to select 4 out of 5 case studies. So identifying the right case study is very important. While scanning, go through both MCQs as well as descriptive questions. This will give you overall sense of topics covered. First, scan entire case study. Okay. After this, select the case study you are more confident. Okay. And carefully read the requirement part. Requirement part is very important. Okay. This will help you understand the specific portion the examiner wants to test. The focus could be on any concept, any strategic model, any accounting standard application, corporate governance, or any taxation or other issues. For example, if the question says to assess competitive environment, okay, it's a common example I give in all sessions. Okay, if a question says to assess competitive environment, this signals the application of Potter's five forces model. Start by sketching the 5 forces on your left hand side of your answer sheet. Okay, now I am guiding about how you are going to draft answer. Okay, for this, to draft the answer in a correct manner, first start sketch making. ठीक है, start by sketching the 5 forces on left hand side of your answer sheet. Then start reading your case study in detail. Identify key points. Identify key points to each force. Okay, for instance, if the case mentions limited suppliers, This indicates a higher bargaining power of suppliers. If there is mention of many competitors in fragmented market, this suggests high competitive rivalry. Make notes directly under each force. Interestingly, most relevant are often concentrated in one or two paragraphs. Okay, you will find relevant connected material in one or two nearby paragraphs only. Okay. Similarly, for other descriptive questions, underline key information, highlight figures, and draw a sketch wherever it is required. This initial work will make it much easier to write your final answer. Now, the question comes, how much to write? Suppose a question is having worth of 12 marks. Okay. For Porter's five forces, divide marks across the five forces, roughly 2 to 3 points per force, and answer with a conclusion. Always apply the model to the case rather than just copying theory from the module. Remember, you have to apply the concept. Marks are awarded for application and conceptual understanding, not for rote memorization. For example, instead of simply listing threat of new entrants, explain how a new competitor entering a specific segment affect the company in the given case. If FR example, suppose now I am taking FR example. Suppose the case mentions that company has a significant intangible assets acquired through business combinations. Here, your understanding of Ind AS 38 and Ind AS 103 allows you to explain how these assets should be recognized, measured, and disclosed in the financial statements. This link FR concept directly with the case, showing both compliances as well as strategic relevance. Now, it is important to understand, students, please note, it is important to understand open book resources are helpful only if you have conceptual clarity. Without it, you may struggle to locate the correct module, find the relevant page, or apply the concept correctly. Blindly searching through the module wastage of time and may affect your performance in other questions. This is the one reason students fail to complete the exam on time even the paper is balanced and standard. If you have good conceptual understanding, only then you can use open book resources in a very well manner. Otherwise, you will end up with wastage of your time only. Please remember, paper is always balanced and standard. Only those who have good conceptual understanding can easily crack the exam and can easily use open book resources. Some students worry about handling group 1 subjects while preparing for group 2. Therefore, I am again saying you must have basic conceptual understanding. Students, please review previous examination question papers. It will help you to understand trend. For example, questions related to AFM are regularly asked in exam. From which portion? From foreign exchange, forex area. Okay. Similarly, from law, corporate governance portion is very, very relevant. Although you may get questions from any area, but these are some areas which are highly relevant. You may carry any material of your choice in the examination, but the core resources should reflect your preparation. You may create indexes, mind map, slow chart, but ultimately the best mind map is your index is your mind. If you have good conceptual understanding, you can find any page without referring any index. Therefore, I am repeating again and again, conceptual understanding is must. At least you should have basic conceptual understanding. In conclusion, a successful strategy for IBS case study have number 1, scanning the case, number 2, understanding requirements, number 3, making notes, underlining and sketching, number 4, applying relevant framework, standard or section, number 5, integrating with other technical concepts, number 6, writing answers according to the number of marks, and next is use resources wisely. It means proper use of open book resources. Okay, by following this approach you can handle any IBS case study and even you will get good score in this paper. Okay students, now it's time to winding up this session. To all students who joined today, thank you for your active participation and your questions. Your interest made the session even more meaningful. Let us today's session remind us the IBS is not just about solving the case study, it's about learning to think like a decision maker. Whether you are dealing with FEMA, tax, or accounting standards, each case is an opportunity to connect with the dots and apply your knowledge with real situations. Keep learning, keep exploring, and most importantly, keep practicing. Wishing you all the best for your coming exams. Once again, a big thank you to Amit sir and to everyone who made this session a great success. Thank you, everyone. And thank
Thanks
you,
a lot,
sir.
Deepalji, and thanks everyone for bringing this kind of practical sessions for students. I mean, it is really helpful, and all the very best to all the students. Thank you, everyone. Bye.
Session over.
Bye bye. Good night.